Hello class and welcome to our 13th lecture series on financial accounting or principles of accounting. And I'm your instructor Jamal Haider. So we last time ended our lecture regarding the methods of depreciation, and we talked about straight line method, we talked about unit of production method, we talked about double declining method, right? And we talked about their, the entries, their illustrations, how we calculated, and how we calculate the last depreciation part of double declining method uh, or accelerated depreciation method. We talked about the last depreciation would be the balancing figure, right? And we did about the illustration as well. Okay, now let's move a step further because we talked about the fixed assets. There are two kinds of fixed assets, tangible and intangible, right? So we talked about the tangible assets, okay, building, plant, machinery, fixtures, furniture, they are depreciated. But land always appreciated. So land is not going to be depreciated. Okay, so let's just talk about a little bit flavor. What happened if we, change the useful life? So for example, a company purchased a car and company decided to have a straight line depreciation for 5 years. Now what happened? After 5 years, the company saw that, okay, what if we overhaul the engine or we, repair this car and it further lasts for 3 more years? But in our books, in our, estimation, we already depreciated all the asset and its useful life is 0 after 5 years. So we are going to dispose it, right? So what happens if we change the useful life instead of, after some time when we are using, what happens if we change the useful life or change any other, estimate? So let's just talk about that. So after an asset in its use, managers may change its useful life or residual value. So what is the formula for depreciation for straight line method? Straight line method? It's
the time, and it's like the initial value divided by the
number purchase value minus residual value divided by useful life, right? Or in mathematical term, you can say that, okay, straight line method is equal to 1 by n into the cost price minus residual value. It's one and the same thing. Okay, so this is purchase price or cost price minus the residual value or salvage value divided by its number of years. So we call this change in estimate. What if the residual value is going to be changed? So we thought that, okay, our car is going to be sold at $1,000 after 5 years. But due to inflation and all this stuff, we sold the car not for $1,000, we sold the car for $7,000 because car was in very good condition and we have a policy we are going to replace it. So we sell the car for $7,000. So what happened? But we book here for $1,000 that our car is going to be sold on $1,000. It means there's a change in estimate. What if life is going to be increased? That is also a change in estimate. So how we are going to treat this one? So accounted for, in its useful life or residual value on the basis of experience and new information. So accounted for the period of the change in future periods, prior years not adjusted for the change. So 1, 2, 3, 4, 5. So we purchased a car and we thought about that. We are going to sell the car after 5 years, or the value is going to be like 1,000 after 5 years, and we are going to replace it. Salvage value or the residual value, we will sell it at 1,000. But what happened at year 3 when you are here? You overall, you send your car to the mechanic and he did the engine overhaul and the life extended to 8 years. So the depreciation you already have calculated in 1 and 2, that is not going to be affected because that expense belongs to previous year. Matching principle is already applied in previous statements, so we are not going to change previous statements, right? So prior years not adjusted for change. So what happened in the previous year stays in the history. That's it, right? So we call this change in estimate. So when managers, accountants, they talk about the depreciation of, increase the useful life or increase in salvage value, as residual value. Sorry, guys. So we call this change in estimate. So when accountants, chartered accountant, chartered public accountants, and they talk about that, they always talk about, okay, we are changing the estimates. And what does it mean? It means they are either changing the salvage value or either they are changing the life. Now, plant assets, natural resources, and intangibles, we talked about that. And what do we mean by the intangible assets? How we talk about the depreciation of intangible assets. So we know that the intangible asset, they don't have the physical form. Then how we calculate the depreciation? So we have a special name for them. We call this impairment. We don't call this depreciation because we are not using them, or this is not a wear and tear that is going to be happen over there. So we call this impairment. So impairment is only used for intangible assets, right? And also for natural resources as well. So we are not diving deep into the natural resources, just going to give you a little hint. So you have a coal mine, and in coal mine and then coal mine, the researcher said that it lasts for 20 years. Every year you extract 100 tons of coal, right? So this 100 ton of coal is your impairment, not depreciation, because that is not the wear and tear. So we divide the cost of acquiring the coal mine into a 20 years into a straight line method, and every year the value decreases. We call this impairment because we are not using that asset, we are extracting it and then selling it or making different stuff, right? Okay. So both tangible and intangible assets must be tested yearly for impairment. Like the coal mine, natural resources, they are tangible assets. Intangible asset, what are those? Like copyrights, goodwill, patents, trademark, right? So these are your intangible assets. So impairment occurs when expected cash flows less than the asset book value. So what is the market value of those assets right now, and what is the value in our books? If there is a difference and market value is lower and our book value is higher, then the rule is that everything should be recorded or cost or less, or market value cost or less, lower of the cost or the market value. But market value decreases. For example, patents. So market value of the patents in your books were 10,000, but if you sell those patents, it will be selling on the market at 8,000. So this is the market value, and this is your book value on the books on the balance sheet. So law says that you are not going to decrease the value of the patents. Why? Because you want bigger balance sheet, right? Bigger balance sheet means the business is worth of, and assets are more because assets is equal to liabilities plus owner's equity, and everybody wants that its balance sheet should be in hefty amount of big numbers. But law says that you need to test for impairment. It means if the value, market value of those assets goes down, patent's value goes down, then you need to record it 8,000. So our patent is going to be recorded on balance sheet at 8,000. So 2,000 in assets decreases. So where that 2,000 will go? That will go to the income statement as an expense. Expense of, we call this expense as impairment. Right? Just a fancy names, concept is the same. Similarly with the plant machinery fixture, value decreases and that decrease is called depreciation. So depreciation will go to the income statement, right? And we make the entries. So same entries, same structure is there. Instead of writing the depreciation, we write down impairment loss, right? So there are rules for impairment. First, the impairment should be tested in 2 steps. Number 1, you see the net book value greater than the expected cash flow. What does it mean? This is finance concept. That how much this patent or this mine will give me cash flows for 20 years, and you make a calculation and you find out its future value and you compare it with the book value. If first step satisfies that the book value is greater than the estimated cash flows, that whatever is written in our books is written as a lower value than the future cash flow that will come in, future cash inflows towards the organization. If that happens, it means we need to test for step 2. If that doesn't happen, then no impairment is going to be recorded. Then the net book value and the fair value. What do we mean by fair value? Fair value means the market value, but difference is that we are not selling it. For example, I want to know that what is the value of my this Microsoft Surface Book pen, and I want to keep. Intention is I don't want to sell. I just want to have a rate in the market that if I want to sell, what it worth of. If it turned out that if I want to sell it, it's going to be sold in the market for 300 yuan, right? I purchased it for 700 yuan, but I didn't sell it, right? So that is called fair value. But the fair value should be evaluated not on your personal, because I used it, so it should be sold at not 700, at least 600 or maybe 500. Or you evaluate with your brother's company, or your brother is accountant, he is evaluating and giving you higher number. Fair means all the parameters of fair market analysis should be there if you really want to sell, but your intention is to keep that, so that value less the book value will be your impairment loss. So if you don't understand that, we have the example here to make you understand what do we mean by the impairment. So to illustrate, let's assume that FedEx has long-term assets with the following information as of the following May 31st, 2012. The net book value is $100 million. Estimated future cash flows that in future the company will receive from this asset $80 million, but right now the book value is 800. So first step verifies, yes, step 1 completed. Why? Because net book value is greater than $80 million. So it means it has to be impaired. Whether this is a mine, whether this is a patent, whether this is your trademark or whatsoever, goodwill, asset is impaired, right? Now, what is the value of the asset?